Matt, we're looking at some stocks that are up today. What do you got?
I've got 5 of them today, David, and let's start with one that we've talked about a few times here recently, and that's Fannie Mae.
It's up, it's down.
Yeah, and actually that's really the story of what it was today when I was looking at the stock this morning. It was up 10%. I went back and checked it again a few minutes later. It was up 1%, and then it was up 2 or 3%. So this is bouncing all over the place today, but it was pretty clear, at least from the morning trading, that it was up more than the market. So, what we've seen here, there were a couple reports. There was one in the Wall Street Journal talking about hedge funds betting on Fannie Mae preferreds. These aren't the preferreds. The FNMA are not the preferreds. That's the common. But we've got these stories about hedge funds betting on the preferreds. The idea is that Fannie Mae and Freddie Mac eventually come back to the private markets, and that would pay off for those betting on it. However, in a separate Wall Street Journal article, I like the way they put it. Ultimately, this is a political bet, not a financial one. Personally, I'm more on the of the mind of making financial bets, not political ones. I never want to have to rely on the thinking of Congress or the president to have the sole outcome of an investment. This is actually a group. So the next 4, this is a group. It's the mortgage REITs. ARMOUR Residential was up 1.6% when I was looking at it. Hatteras up 1.2%. Annaly Capital and American Capital Agency both up 0.5% when I was looking at them.
Those have all been hurt recently, right?
Those have all actually been down. A funny note on ARMOUR, it certainly wasn't, has nothing to do with Cramer, Jim Cramer on this one. He commented on the Mad Money show yesterday. This one is too hard. I don't know what the Fed will do. Honestly, I kind of agree with Cramer. But the gains today, so we're looking at, there were a couple of disappointing economic reports. Jobless claims jumped to 360,000. They were expected to jump, just not quite that much. Housing starts for April were down 16.5%. Again, they were expected to fall, not that much. So you've got some, weak signs for the economy. At the same time, the price index, so when we talk about price index, inflation, yada, yada, seasonally adjusted for April, down 0.4%. Again, that was softer than expected. So put this all together, and you've got a journal headline today that says Treasuries soar after disappointing data. So basically, I think people are looking at this, investors are looking at this and expecting that this will convince the Fed to continue monetary accommodation. This is a good thing right now for the mortgage REITs because this keeps their funding costs low. Even though their asset returns are falling and their spreads are tightening,
it's better than a quick reversal.
Exactly. One of the big concerns over the mortgage REITs right now is when that reversal happens, what will happen to their spreads? I mean, will they even stay positive? So to the extent that the Fed keeps rates low, it's at least a short-term positive for them. So I think that's what we're looking at here with these.
Great.
Moving on.